It's easy to say the Federal Reserve was born out of necessity. That the country nearly collapsed in 1907, and adults in the room had to invent a central bank to keep the lights on. But necessity is a slippery word. Because in 1907, the United States didn't lack money. It lacked trust. And when trust breaks, someone always offers to fix it, usually in a way that also fixes the rules in their favor. So the real question isn't whether the panic of 1907 was bad. It was. The question is why that panic became the one that proved America needed a central bank, when earlier crises had already shredded banks, wiped out savings, and set off riots. Why did this collapse become a political lever, not just a financial disaster? And who got to hold the lever? In 1907, American finance didn't look like the clean diagrams in textbooks. It looked like a city built on narrow bridges. There were national banks with strict rules and limited flexibility. There were state banks with looser rules. There were trust companies, fast-growing hybrids that sounded safe but were less regulated, more aggressive, and often more exposed. There was also a system designed to be safe by being rigid. Banks were tied to reserve requirements, and reserves were tied to specific places. Money pooled in New York. When the harvest season hit and cash was needed in the interior, money drained away from the city. When fear hit, money rushed back. The system was always tightening and loosening like a clenched fist. And then there was the quiet reality everyone understood but rarely said aloud. In a crisis, the country already had a central bank. It just wasn't a government institution. It was a network. A handful of powerful firms. A few men with the reputation, capital, and reach to act as lenders of last resort when the official state wouldn't or couldn't. When panic hit, people didn't look to Washington. They looked to a private address in New York.
Keep it quiet.
That arrangement worked until it didn't. Because it depended on one thing, that the private rescuers would always want to rescue. In the fall of 1907, the spark wasn't a war or a natural disaster. It was something smaller and more modern. A bad bet. A scheme that went wrong. A group of speculators tried to corner shares of a copper company. The attempt collapsed. The losses cascaded outward through brokers, lenders, and institutions that had touched the deal. Suddenly, suspicion became contagious. People started asking a question that destroys banks faster than any math. Who's next? They didn't need proof. They needed only a rumor, a headline, a nervous glance at a teller window. One institution became the target early, a large trust company that seemed solid until it wasn't. Depositors lined up. Money left in waves. Other trusts watched, helpless, knowing that the public didn't care about the differences between them. Fear doesn't do nuance. And this is where the story always gets simplified. We're told the panic spread because the system lacked an elastic currency, because cash couldn't expand to meet demand. That's true as far as it goes. But it doesn't explain why some institutions were protected and others were left to bleed. It doesn't explain how confidence was restored, not by policy, but by deal-making. Because the crisis response wasn't a single heroic act. It was a series of decisions about who would be saved, on what terms, and at what price. When the panic intensified, banks and trusts needed immediate cash. Not tomorrow. Not after a committee meeting. That day, that hour. But the normal channels froze. The Clearinghouse, a private association of banks that function like an emergency nerve center, started issuing something close to substitute money, certificates that let banks settle accounts without using scarce cash. It was triage, improvised in real time. Meanwhile, the public saw a different picture. Lines. Locked doors. Newspapers printing numbers like obituary notices. The sense that modern prosperity was a thin varnish. And then the most important thing happened, not in public, but in private rooms. The financial elite began meeting, not to debate whether to stop the panic, but to decide how. They weren't neutral referees. They were players in the same game. Their motivation wasn't simply civic duty. It was survival. A collapse could destroy their own holdings, their own institutions, their own credibility. But survival doesn't make a rescue disinterested. It makes it strategic. At the center of this strategy was a brutal logic. You can't save everyone. Not fast enough. Not with finite resources. So you choose. And every choice sends a signal. If you support one institution, you reassure its depositors and counterparties. You may also reassure the market that similar institutions are safe. But you also take on their risk, and you set a precedent that future behavior might rely on. If you refuse to support another, you might discipline reckless behavior. Or you might simply let a competitor die. The line between moral hazard and market share is often a matter of viewpoint. The panic of 1907 forced that line into the open. Trust companies were vulnerable because they were less regulated and held fewer cash reserves than national banks. They had grown rapidly in a system that rewarded expansion and punished caution. In good times, they looked like innovation. In bad times, they looked like loopholes with lobbies. When depositors ran, trusts couldn't meet withdrawals. They needed cash from banks. But banks, staring at their own fragile reserves, were reluctant to lend. The system locked itself into a reflex: hoard cash, distrust everyone, protect yourself first. So the country turned, again, to the private central bank it never admitted it had. Not a charter. Not a mandate. A reputation and a balance sheet. The rescue effort was not just about injecting money. It was about controlling information. You had to convince the public that the crisis was containable. That the line would end. That the doors would open tomorrow. That kind of confidence is not produced by speeches. It's produced by visible power. Money placed where everyone can see it. Loans announced. Institutions publicly endorsed. Backroom agreements transformed into front-page reassurance. And it worked, partly. But it also exposed something uncomfortable. A private network of financiers had just performed a public function. They decided who got emergency credit and who didn't. They stabilized the system, yes. They also demonstrated how much of the system revolved around them. That's the part that gets rewritten later. Because once the crisis faded, the question became political. Not how do we stop panics, but who gets to stop them? If the country's stability depends on a handful of private actors making emergency decisions, then those actors effectively hold veto power over the economy. That might be fine when the public believes they're benevolent. It becomes a problem when the public realizes their interests are not the same as everyone else's. 1907 didn't just terrify depositors. It terrified lawmakers. Not because they suddenly cared about bank runs on principle. But because they saw what happened when Washington lacked tools. The Treasury could move money around, but it wasn't built to be a rapid response lender of last resort. The government could regulate, but it couldn't improvise credit at the speed fear travels. And in that vacuum, someone else did. So the political pressure took shape quickly. If panic was inevitable under the current system, then reform was inevitable too. The only question was what kind of reform and who would design it. This is where the word justified becomes interesting. A crisis can justify almost anything if you frame the alternative as chaos. But reforms aren't born in a neutral lab. They are drafted by people with preferences, alliances, and incentives. The panic of 1907 became the strongest argument for a central bank, not simply because it was severe, but because it revealed the limits of the old compromise. America had long distrusted central banks. It distrusted concentrated financial power, especially when it seemed aligned with political power. The country had fought earlier battles over national banking and monetary control. Those battles weren't just ideological. They were about who would benefit from the system's design. So for decades, the United States lived with a patchwork. A banking system that was national in name but fragmented in function. A currency system that was stable in theory but brittle in practice. A financial market that was modernizing faster than its rules. 1907 made the brittleness impossible to ignore. Yet the paradox is this: the panic didn't prove a central bank was the only solution. It proved the current system needed a reliable lender of last resort and an elastic currency mechanism. Those functions could be structured in different ways. What became the Federal Reserve was one answer, crafted under specific political and financial constraints, shaped by the people allowed into the room. The turning point wasn't just the panic itself. It was the post-panic negotiation. The moment when the country asked, "What happens next?" and the answer came from a familiar set of voices. Reform commissions studied the crisis. Bankers, economists, and politicians debated how to prevent repeats. Public anger simmered. Populist suspicion of Wall Street didn't disappear just because the panic ended. If anything, it sharpened. And here's the key: both sides could use 1907. Those who wanted more centralized control could point to the paralysis and argue that only a central institution could provide stability. Those who distrusted concentrated power could point to the private rescue and argue the opposite, that the system was already captive to financiers, and a central bank might formalize that captivity. So how did the central bank idea win? By changing the packaging without abandoning the core. A pure central bank model, openly run by government, would have been politically toxic. A pure private bank cartel would have been publicly unacceptable. The solution that emerged was a hybrid, one that could be described as public enough to reassure voters, and banker-friendly enough to function inside the existing financial reality. A system of regional reserve banks. A central board. A structure that looked decentralized on paper but could coordinate power in practice. A design that could be sold as reform without sounding like surrender. That's the part people miss when they ask, why did they need to create the Fed? They weren't a single group. There were reformers who sincerely wanted stability. There were bankers who wanted predictability and protection from destructive runs. There were politicians who wanted to avoid being blamed for the next crash. There were also powerful interests who saw an opportunity to shape the rules of credit for generations. The Fed was not created simply to stop panics. It was created to define who gets to decide what a panic is and what counts as a solution. Because once you build a lender of last resort, you also build a gatekeeper. Someone sets the terms of emergency. Someone decides what assets count as acceptable collateral. Someone decides which institutions are systemic and which are expendable. Someone decides what stability means. In 1907, those decisions were made privately, improvised, and largely unaccountable. After 1913, those decisions would be institutionalized. That doesn't make them automatically better or worse. It makes them durable. And durability is power. The real pivot in this story isn't a bank run. It's the shift from ad hoc rescue to permanent architecture. The shift from "we had to do it" to "this is how it will be done from now on." And like all permanent architecture, it reshapes behavior. A banking system without a backstop forces banks to hold more liquidity and avoid certain risks. It also makes runs more likely, because everyone knows there is no safety net. A banking system with a backstop can reduce runs by reassuring depositors, but it can also encourage risk-taking if actors believe rescue is likely. So the very tool designed to prevent crises can change the incentives that produce them. That's not a moral accusation. It's a mechanical observation. Now, zoom out. Imagine you are a lawmaker in 1908 watching the fallout. Your constituents are furious. Their savings are locked up. Businesses can't make payroll. Farmers can't get cash for transactions. Newspapers are accusing Wall Street of sabotage and incompetence in the same paragraph. And then someone tells you, the reason this happened is because the currency couldn't expand quickly enough, and the banking system is too fragmented. And also, by the way, the only reason it didn't get worse is because a private group of bankers coordinated a rescue. What do you do with that information? You can refuse reform and accept that panics are the price of freedom. But can you survive politically after the next one? You can impose heavy regulation and break financial power into smaller pieces, but can the market function at modern scale without coordination? Or you can build a central institution, claim it belongs to the public, and hope it keeps the panic contained. In that moment, the Fed becomes less like a philosophical choice and more like an emergency compromise. But compromises have authors. The Panic of 1907 didn't just open the door for a central bank. It made the absence of one look irresponsible. It made inaction look like negligence. It made the next crash a foregone conclusion unless someone did something. And in politics, inevitability is a weapon. If you can convince the public that reform is inevitable, then the debate shifts from "should we do this?" to "how should we do this?" And how is where power lives. That's where details get written. That's where winners and losers are built into the structure. So when people say 1907 justified the Fed, they're describing a rhetorical move. A way to take a complex crisis and turn it into a simple argument: we need a central bank, because look what happened. But the deeper truth is that 1907 justified a reallocation of authority. From scattered banks to a coordinating system. From private emergency rooms to an institutional triage center. From improvisation to policy. And, crucially, from local vulnerabilities to national leverage. Because once credit becomes centrally managed, it can be expanded or contracted in ways that shape the entire economy. That influence doesn't only appear during panics. It appears in booms, in elections, in wars, in expansions and recessions. That's why the Fed matters beyond 1907. It's not a museum piece. It's a power switch. And the reason the Panic of 1907 is remembered as the crisis that made the Fed is because it provides a clean origin story. A moment where fear made everyone agree, where the solution looks like common sense. But origin stories are always cleaner than reality. The reality is that the Fed was the product of pressure, fear, and negotiation, built to solve one set of problems and inevitably creating a new set of dynamics. It was a response to a system that had become too complex to be governed by 19th century rules, and too politically fraught to be openly centralized. In that sense, 1907 wasn't just a panic. It was a demonstration. A demonstration that the nation's financial stability could be controlled by private coordination. A demonstration that the government lacked a rapid toolset. A demonstration that modern capitalism required centralized functions, whether the public liked it or not. And once you've seen that demonstration, you can't unsee it. So here's the question that lingers when the credits should roll. If 1907 proved the country needed a lender of last resort, did it also prove that whoever controls that lender controls the definition of emergency? And when the next crisis hits, whatever form it takes, whatever name it's given, who will get to say, with a straight face, that the solution is simply necessary again?